Buenos dias, buenas tardes, buenas noches. Yeah, good morning, good afternoon, good evening. Yeah, I don't know when you're watching this, listening to this, but welcome. Welcome to Business 123 Introduction to Investments at Southwestern Community College for fall 2024. My name is Frank Paiano, and I'm the instructor for your class. And I introduce myself elsewhere. There's plenty of little videos and documents to take a look at for getting started in our class. The syllabus, the most important document of the semester that everybody puts in the back of their notebook and never looks at again. But here we are in our first presentation, Investments, Introduction to Investments. Chapter 1, Getting Started. Welcome, everyone. Welcome, welcome, welcome. We are so, all of us at Southwestern, we are so proud and grateful and honored and happy that you're with us. And of course, if you're not enrolled in the class, welcome it also. That's not important. Everyone is welcome. If you want to follow along, please do. Contact me. As you'll see, if you nose around the website, there's an investment club that you can join. Everyone's welcome. There's a chat group that one of the former students has organized. So yes, it's a little bit of an environment here, isn't it? Let's get started with a perspective. It is a gloomy moment in history. Never has the future seemed so dark and incalculable. The United States is beset with racial, industrial, and commercial chaos drifting we know not where. Of our troubles, no one can see the end. Who wrote this? Who said this? When? Did you see this on Skunk News last night? I'm sorry, Weasel News, Badger News, Fox News. Yes, the end of the world is upon us. Most people would say, maybe Great Depression, World War II, maybe 9/11. Actually, it was Harper's Magazine, 1847. Did they have serious issues in the 1840s? Yes. Oh, yes. The United States, was about to tear itself apart in the Civil War over slavery. Do we have serious issues now? Yes. But equating serious with fatal so far has been wrong, although we do have a serious individual who wants to get rid of the democracy and replace it with a dictatorship, and hopefully doesn't win. We'll see. We'll see what happens. Supreme Court wants him to be a king, a dictator. We'll see. I'm optimistic, not really. But I do remember a wonderful gentleman by the name of Louis Rukeyser, who was one of my teachers online, television, who ran a investment show long before investment shows were on cable television. Wall Street Week with Louis Rukeyser. And he said this country is so fundamentally strong it can survive its leaders. We're going to see that very, very soon. We're going to see that very, very soon. But let's be optimistic, because the last 200 years have been the most prosperous years in the history of the world. You go back to the 1840s, and they didn't even have toilets yet. Yeah, our standard of living is unbelievable to somebody living 200 years ago. Right, 20 years ago, 40 years ago, these have been the most prosperous times. And I firmly believe that the next 20, 30, 40 years are going to be even better, providing we don't blow ourselves up, die in our own waste. Tsunami, meteorite, disco returning. You laugh, but you didn't live through the 1970s, folks. It was a very difficult time. So we're going to emphasize the positive, even though the negative is always with us. And it turns out that optimistic people in general are happier, healthier, and more profitable, wealthier. So let's stay optimistic. As the saying goes, be ye joyful, even after you've considered all the facts. The pessimists just say, well, they're not being realistic. We'll see. Yeah, no guarantees. The management assumes no responsibility. There are no guarantees, but let's be optimistic. Chapter 1, Introduction, Overview, and Risk versus Return. So this chapter is going to set the stage for the entire semester, folks. So do read the book. It's free. Do the assignments, the worksheets, listen to the presentations, watch the presentations. We do our best to help you with time management while you're commuting. If you're driving, you can listen to them. If you're on the bus or whatever, you can watch them on your cell phone while you're walking the dog on the treadmill. Yeah, do. And it's so telling, folks. I mean, I've been teaching this for a while. And it's so telling when you see people turn things in, submit work or take the exam. And they didn't watch the presentations. They didn't read the book. They didn't, no, please do it. I know time is so important, but you can do it. We're counting on you. We want you to be awesome. We want this to be the best class you've ever taken. And we want you to be rich. And there's possibly, for some of you, especially younger or maybe older, doesn't matter, a career for you in the investment services, financial services industry. We need more people. There's a whole bunch of us old guys ready to retire or die, and we need new blood. They especially want more women, minorities, bilingual, veterans, love veterans. And people say, oh, it's because of diversity and all that. No. It's because of business. If you have an insurance agency in the South Bay of San Diego and you don't have somebody who speaks Spanish, or a brokerage firm or a bank, right. If you're out in East County, you don't have somebody who speaks Arabic, you're losing business. It's that simple. Nothing to do with diversity or anything like that. Now, this quote by J. Kenfield Morley sets the stage for everything we do. In investing money, the amount of interest you want should depend upon whether you want to eat well or sleep well. He got it. Now, I wouldn't have used the word interest because interest is just one type of investment reward. I would have said investment reward or the amount of return you want, because there's other ways to earn money through investments than just interest. Interest is on bonds and on savings accounts. There's also dividends on stocks and rent payments from real estate. But that's the idea. Do you want to eat well or do you want to sleep well? Because there's no way to eat well and sleep well, folks. It just doesn't work that way. What we're going to learn are some techniques that should help us eat reasonably well and sleep reasonably well. So stick with us. And we're going to learn some techniques to help us when those times when the markets fall and people are ready to jump off the cliff or the ledge and sell all their investments. And no, that's the worst possible time. That's the time you want to buy more. So stick with us and remember, do you want to eat well or do you want to sleep well? And we're going to do our best to help you eat reasonably well and sleep reasonably well. Slide number 4. We start from the very beginning with the question, what is an investment? An investment, now there are a few different variations of definitions depending on who you talk to, but this is the one we'll use here. An investment is any vehicle, sometimes people use the word instrument, into which resources can be placed with the expectation that it will generate positive income or that its value will be preserved or increased or both. So we're looking for two things, folks. We're looking for income and increased value, or at least, doesn't lose value. This next definition is by none other than the father, sometimes called the father of value investing, Benjamin Graham. He was Warren Buffett. And if you follow the culture, you've heard of Mr. Warren Buffett. He was Warren Buffett's teacher. He wrote, an investment operation is one which, upon thorough analysis, so we're going to do our analysis, promises safety of principal and a satisfactory return. Operations not meeting these requirements are speculative. So we're going to make this distinction in this chapter and throughout the semester. Are you an investor or are you a speculator? Now, when you see the word speculation or speculative or speculating in the world of investments, when you see that word, you replace it with gambling. All right? Okay. Relax. We're going to discuss this in detail in further along. But we want to ask you a question. Are you an investor or are you just gambling? I'm sorry, speculating. So, as we said, investment rewards come in two flavors. Income from interest, dividends, rent. They're also called cash flows, cash inflows and cash outflows. Yeah, what do you got to pay to get the investment? Cash inflows, what's coming in the door from the investment, and the increased value or decreased value. And these go by the name capital gains or capital appreciation. And of course, yippee, everybody wants the capital gains, everybody wants capital appreciation, but we can also wind up with capital losses. Ugh, yeah. So remember, income and capital gains. Income, and some people use the word growth for capital gains, increased value. Investments come in all shapes, flavors, and sizes. So now I want you to get a sheet of paper out or the study guide from chapter 1, and we're going to go through these attributes, these characteristics that at first may seem a little fuzzy. Don't worry, we're going to get into more detail. Right now, we're looking at the investment world from way back. We're just looking at the forest, not getting into the trees yet. There are three types of investments. These are the big three. Securities. Oh, what a horrible term, securities. You can think of, when you hear the word securities, you can think of financial investments, okay? These are investments that represent debt or ownership or the legal right to acquire or sell an ownership interest. What? Relax. When you hear the word securities, think of financial investments. And some of these securities really aren't investments. They're really gambling, as we'll see as we go along. But that word securities is a very unfortunate word. In fact, we used to call this class investments and securities. And students would say, but I'm not an administration of justice student. No, not that type of security. You've heard of the Securities and Exchange Commission. Yes, this is the group that's regulating the financial investments. Properties, real property. What a silly name, real, as opposed to imaginary property. No, anything that's attached to the ground or ground itself is real estate. You've heard real estate, right? Personal property such as gold and precious metals, jewels, automobiles, art, collectibles, etc. These go by various names: hard assets, tangible assets, and we'll see much later on there's a way to, I don't want to use the word invest because for the vast majority of us, they're not investments, they're speculations. But there's a way to actually get involved in the commodities world. What does that mean? In other words, we could buy wheat. We have no need for buying, well, we buy 5 pounds of wheat, but not 5,000 bushels of wheat. And there's a way to actually get involved in that world. For the vast majority of us, stay away. They're called futures, or specifically futures contracts. And so, securities and property. Now, what's the third type? Well, personal investments. You are investing in yourself by taking this class. And none other than Benjamin Franklin said, an investment in education pays the best returns. So why are you bothering to take this class? Because you're hoping that you're going to better yourself. And that's the best investment. People say often, what's the best investment you ever made? I said, going to college, getting my associate's, my bachelor's degree and then my master's degree was the best investment I've ever made. And they say, what about a real investment? I said, that was a real investment. You got it ain't easy, right? You just don't walk up and they give you the diploma. No, you got to work for it. Our class is going to concentrate on securities. We'll discuss property and real estate, and other types of tangible assets at the end of the semester very quickly. For the vast majority of us, no, they're not investments. People say, what about real estate? Relax. Most people are going to endeavor to buy their own home. Well, right there, you have an investment in real estate. And real estate, folks, is not for the faint of heart, especially here in San Diego. Now, we're going to differentiate investments into two major classes: primary assets and derivatives. Primary assets then fall into two categories: debt and equity. You're going to either lend your money to somebody else, and those are savings accounts. Those are bonds, not James Bond or Barry Bonds, but loans, or equities where you're the owner. So the primary assets, you could be a loaner, Loaner, or an owner, Owner. And that makes sense, right? Sometimes you're the lending the money, you're playing the part of the bank. Sometimes you're playing the part of the partner or the owner of the business. What are these derivatives? Well, folks, notice here's the word speculative. These are securities that derive their value from an underlying security or asset. What? They're not the asset? No, they are something that points to the asset. And oh boy, aren't these confusing, and oh boy, aren't these dangerous. And all you have to know for chapter 1 is that these things exist. Derivative assets derive, there's the word, derive their value from an underlying something else, a security or an asset, and they are very dangerous. You hear people say options and futures, but really the technical terms are options contracts and futures contracts. And of course, both of those are hard to say. Try saying options contracts 3 times fast. But really, folks, we're going to teach you to stay away from these things because they're very, very dangerous. Some people like to go to Vegas. They like to gamble. They go to the slot machines. You might like options then, but doesn't mean you're going to make any money. You might, you probably won't. Futures are even worse. Futures are very dangerous for the vast majority of us. It's not that they're not important. They are important to the global economy. But unless we're working in that industry, such as oil or farm goods, stay away. And notice that some in the industry do not classify derivatives as investments. I'm one of them. I call them speculations. And we know you've already learned when you hear the word speculation in the world of investments, substitute the word gambling. Now, investments are also categorized as direct investments, where you're in control of the investment, your name is on the investment. We often use the term registration. How is the investment registered? Or indirect investments, where somebody else is in control of the investment. So what are direct investments? When you buy real estate, your name's on the title. Buy real estate directly, you buy stocks and bonds, your name is on the account. You're in charge of those stocks and bonds. There are types of investments where you give your money, you invest your money with an entity such as a mutual fund or a real estate investment trust or a limited partnership. And you are not in charge of what is invested. You own shares in the partnership, you own shares in the mutual fund or the real estate investment trust, but somebody else is actually making the decisions about what they're going to invest in. That makes sense? So direct, indirect. We're going to learn about both of these because there are times when you want to be a direct investor. People want to buy their own individual stocks or bonds. And there are other people who say, well, you know what? After taking this class, I don't know that I want to purchase individual stocks. I'm going to buy mutual funds that will buy the stocks for me. So again, we're getting a little ahead of ourselves. We're going to look at everything from far away and don't worry, we'll get into the weeds soon enough. Now, we also need to know the domesticity, which is a fancy word for where do they get their mail, right? And this used to be very important, but not so much anymore. There are 3 categories: domestic, international, and global. Wait a minute, Piano. Wait a minute. Domestic is easy enough, right? That means it's based in the United States. International, global, foreign, don't they mean all the same thing? No. Global in the world of investments means domestic and international. International, sometimes called foreign, sometimes called overseas, means everything outside the United States. So you have to be careful of this subtle distinction because if you're in the world of investments, they're going to expect you to understand it. International, foreign, overseas does not mean global. Global is todo el mundo. Right? Domestic is based in the United States. Foreign is based outside the United States. International is based outside the United States. But this distinction was very important 50 years ago, 100 years ago, but not that much anymore. The world is a very small place these days economically, said a wonderful money manager who's since retired. 65% by value of the parts in the Ford Mustang come from the United States and Canada. 90% of the parts in the Toyota Sienna, which happens to be built in Indiana, come from the United States and Canada. So which is the more American car? How can you find a more American car than a Ford Mustang? Buy a Toyota Sienna. And some companies based outside the United States do a large, if not a significantly large, more than 50% of their business inside the United States. And some companies inside the United States do a significant proportion of their business outside the United States. You've heard of Coca-Cola? It's based in Atlanta. That's in the United States, right? It's a United States company. 80% of their revenue comes from outside the United States. So if every United Stater decided they weren't going to drink fizzy sugar water with a brown crayon dipped in it, Coca-Cola would still be a huge enterprise. And there is at least one company that is based in the United States that doesn't sell their products in the United States. So actually, they've added some products to the mix, so they do sell some things. You might have heard of Philip Morris International. There's Altria, which sells the Marlboro in the United States, and Virginia Dims. And then there's Philip Morris International, which is based in the U.S., but sells their cigarettes outside the U.S. Figured that one out. Oh, by the way, they have a new CEO who's a woman. She's not a woman, she's a woman. Check it out, right? We're gonna do that. We're gonna just sniff out some companies that are run by women because it's about time the women took over. We guys have been screwing things up for 4,000 years. It's time for the women to take charge again because they were in charge before then, but now they're fighting their way back. Okay, so that's domesticity. Let's do a little quick, not to spend too much time on this. In the face-to-face class, of course, we try to get people to yell out which ones are foreign, which ones are domestic. Who in this list is a foreign company? Who is a domestic company? You think about it for a couple minutes, a couple seconds, maybe pause, and we'll go through them all. Budweiser, okay? Mother Bud. How can you get more American than Budweiser? It's actually a foreign company. It's owned by a Brazilian Belgium consortium. How about Shell Oil? Royal Dutch Petroleum. It's often called a company, which is a country unto itself. They own the country of Nigeria. Ben and Jerry's. Yeah, no, they were bought by Unilever, which is a UK company. But now I heard that Unilever might be selling Ben and Jerry's. Farmers Insurance used to be based in the United States, but now it's owned by a Swiss company. Arco is owned by British Petroleum. Gerber is owned by Nestle. Firestone is owned by Bridgestone. Cup of Soup is another UK company. And Fox News. Come on. How can you get more American than Fox News? It's actually an Australian-based company called News Corp. And of course, if you don't believe what Fox News says, then obviously you're not an American. You're an Australian. Seagram's used to be based in Canada, but now it's broken up into all the different pieces. And my understanding is part of it might actually be purchased by an American company. Figure that one out. Bayer is based in Germany. Vaseline is another UK company. Friskies is Swiss. It's owned by Nestle. Yeah, they don't just sell human food. Trader Joe's is owned by Aldi, the German company. 7-Eleven is a Japanese company. Now, wait a minute. There's a real interesting story. If those of you who are really interested in the business world, 7-Eleven was based in, I think, Dallas. Southland Corporation is what it used to be called. And they started back in the late 80s, a subsidiary in Japan. And it turns out the Japanese love small stores. And in Japan, it's like going to the grocery store when you go to a 7-Eleven. They have everything. I don't know how they do it because they're small, but they do it. And 7-Eleven got so popular and so prosperous in the Japanese world, they turned around and bought the United States 7-Eleven. And I don't know if you've gone to Mexico lately, but OXXO is everywhere. And 7-Eleven said, we want to get part of that. So now you see 7-Elevens throughout Mexico. You also see Circle K in Mexico, and the other one called Kiosco. So it turns out the Mexicans like small stores also. Now Volvo and Saab, right? Of course, they're foreign. And actually, for 20 years, Volvo was owned by Ford and Saab was owned by GM, but not anymore. Now Volvo is owned by, I think it's called Geely or Geely. It's a Chinese company, and Saab, I think, is owned by this some place in the Netherlands. But they I don't think they make very many cars anymore. They certainly make jet fighters and other materials. So some people get really upset about this. They get really angry, and they say, "Oh, this is ridiculous! America's being taken over." And the answer or the counter argument is, no, you don't understand. This is what we want. We want the world to be global. We want everyone to be intertwined, because then you don't bomb your you don't want to bomb your customers. And people sometimes say, it's touchy-feely stuff. No, we want to make money. we want the world to be well-fed and well-clothed and well-sheltered. Why? Because that means the companies that are producing those services and goods are doing well, and we as investors are doing well. So it has nothing to do with touchy-feely liberal stuff. We want to make money. I think so. We'll see. You never know. Before World War I, they said, we would never have the Great War, which is what they called World War I before World War II came along, because they were all intertwined. Well, it didn't work. They still had it. And hopefully we won't do it, because, World War I, how many people? 30-some million people. World War II, 70 million. World War III, 500 million people will die within a few weeks. So we don't want to think about that horrible situation. We need to persevere. We need to be optimistic. We need to make money by selling the goods and services that keep people alive, because it turns out when people in traditionally lower socioeconomic countries start making more money, they want the things that we've taken for granted for over 100 years. They want clean water, and they want safe food, and they want the Nike shoes, and they want Marlboro cigarettes, and they want Dannon yogurt, and they want to watch Star Wars, and they want a cell phone. And I'm optimistic. We'll see. We'll see what happens, because it only makes sense if you have a family and your kids are doing well and you have food on the table. You don't want to strap a bomb to yourself and blow people up. I don't know. Let's concentrate on what we can do to further the global economy and help everyone have a good standard of living. It sounds like an advertisement, doesn't it? Slide number 10. Speaking of which, global investing. Which country has had the best average annual return over the last 50 years? So here are the top 10 countries according to per capita income. They're not the top 10 economies in terms of gross domestic product. These are the companies that are the wealthiest on a per capita, per person basis, in alphabetical order. Now, who do you think's at the top of the list, huh? Yeah. It's not the U.S. It's Sweden, Denmark, Netherlands. Wait a minute. Those are socialist countries. They have universal health care. How dare they? They send their kids to college and they don't want to leave the university with $120,000 worth of student loan debt. and yet they've done better than the United States. Look at the bottom. At the bottom? Italy, Austria, Spain, Japan. What's going on there? It turns out that as your demographics start falling, start losing people, it hurts your economy. Yeah. So if you go to Italy, they'll pay you to get pregnant. Right? And they'll help you. They'll say, hey, come to Italy and we'll sell you a house for €1, which is like $1.20. Of course, it's going to cost you $30,000 to get it back up in order. But still, a whole lot better than we just broke 1 million medium price for a house in San Diego. So they want people to come to their countries. Now we're going to return to this. Don't worry. We're going to return to this. The United States is no slouch, folks. Oh, by the way, this information is getting harder and harder to find. So if any of you are data miners, are good, I'm not a very good data miner. I would really appreciate if you can help me update this because this only goes up to 2021. And here are some of the wonderful places I went and dug through to get this information. Slide number 11. When we make an investment, one of the first things we have to ask ourselves is what is our time frame? And there are various time frames depending on who you talk to. This one right here, the first one here that you're looking at, unless you're listening to this, up to a year or so is short term. 2 to 5 years is intermediate term, and 5 or more years is long term. That's the typical time frames you'll see in the industry. So short term is up to a year or so. Now, I tend to take a little longer view, and this is if you're watching this, the ones at the bottom, I disagree with the general guidelines. Mine are short term 1, 2, maybe even 3 years, depending on how important the goal is. Intermediate term 3, 5, 6, or 7 years. Long term for me is 7, 10, 20, 30 years. And you'll notice that these second group, they're a little offbeat. You won't see that too often, except in the life insurance industry. The life insurance industry is more longer term. But these are the ones you should remember. And again, remembering, they're not set in fast, hard in stone. But up to a year, short term, intermediate term, 2 to 5 years, long term, 5 or more years. Now, some of you are going to go to Investopedia. And Investopedia is going to say short term is up to 5 years. That's ridiculous. That's ridiculous. I mean, sure, for Caltrans or for the federal government, 5 years is short term, but not for you and me. No. So just ignore that Investopedia definition. Slide number 12. Are investments liquid or are they illiquid? A liquid investment means that it is easily and quickly converted into cash. There's a ready market to purchase the investment and change of ownership happens quickly. For the vast majority of the investments that we're going to look at throughout the semester, they are very liquid. Somebody wants to buy your stock, somebody wants to buy your bond or your mutual fund or your real estate investment trust. Now, the poster child for illiquid investments is real estate. You sell a stock, it used to be you got the money in 3 days, then 2 days. Now they're going to give it to you in 1 day. You get your money next day. Mutual funds, get your money next day. Bonds, next day. Real estate? No. Usually takes, 3, 4, 6 months to sell a house. Larger buildings, commercial real estate could take years to sell. And so partnerships can be the same way. It can be difficult to get out of the partnership. Collectibles, finding somebody who wants that, 1964 World's Fair memorabilia, whatever it is, might be difficult. So the liquid investments may be difficult to convert into cash. The market for the investment is small, or change of ownership happens slowly, or both. So just remember that. The poster child for illiquid investments is real estate. All the investments that we deal with that are securities, very, very liquid. And then last, risk versus return. Do you want to eat well or do you want to sleep well? Now, we're going to have to change our view of the term risk here. Because when people think of risk, they think of the possibility of harm or loss or danger. And certainly losing your money certainly does seem like a difficult situation to suffer harm and loss. But in the investment world, we define risk as the chance, the probability that the actual investment return will differ from the expected return. Huh? We expect to get a certain amount of money from this investment. We might get more, we might get a lot less. And we're going to find that the higher the expectation of investment return, the higher the risk level. And it just makes sense, right? You're going to want to make more money, you're going to have to take on more risk. If you're willing to earn much less, you could sleep better at night. And we're going to really attack this in the third presentation of Chapter 1, but we're going to deal with it throughout the entire semester because understanding the risk-return profile for any investment is absolutely essential before we actually invest. We have to understand, we have to have our eyes wide open and be prepared emotionally for those times when the risk, when the investment return is not what we expected it to be, is it? So now here are my guidelines. Some other people might have a little bit more aggressive. You'll see different ones, but here's the ones we're going to use in this class. Low risk is 3 to 5%, maybe even a little less. Moderate, 5 to 8. High risk is 8 to 12. Anything greater than 12, folks, is very speculative. In fact, I usually try to, I don't even use 11 or 12. I usually say 8 to 10. 8 to 10% is risky enough. And what do we know about the term speculation? It's not investing. It's gambling. So if anybody tells you that they have a risk-free 12% return, you just walk the other way because they might even be, usually they're just trying to bamboozle you. They're trying to scam you. But sometimes they believe it themselves and they actually get harmed just like the people they hooker into the situation. And so remember, do you want to eat well or do you want to sleep well? And as we've said, and we'll say over and over again, we're going to do our best to help you eat reasonably well and sleep reasonably well. Slide 14. So now that you have those characteristics and those labels and attributes, you're going to study them, of course. That's why we have the study guide. What type of investment is a Bank of America savings account? You go down to Bank of America and open up a savings account. Is it a security or property? Remember, security is a fancy word for financial investment, so this is a security. Is it debt or equity? Now, you think of it as equity, right? Ownership. But no, you're not buying part of a Bank of America. You are lending your money to Bank of America. And don't worry, they promise to pay you back. So it is debt. Is it direct or indirect? Well, unless you've done something differently with the lawyer or something like that, your name's going to be on the registration. It's going to be a direct investment. So it'll have your name there on the account. Is it domestic or foreign? Well, Bank of America used to be based in San Francisco. Now I think they're based in Charlotte, North Carolina, right? I think so. Short-term, intermediate term, or long-term. Savings accounts, as we're going to see when we get to the last presentation of Chapter 1, where we just get through savings, short-term investments and get them out of the way, is a short-term investment. Now, some people will have a lot of money in a savings account for the long term. They have not taken our class. They need to take our class because the banker is very happy that you're having $500,000 in a savings account earning, very little money. But you could do a whole lot better. That's called opportunity cost, which is, you learn more about that in an economics class. Is it low, moderate, or high risk? It's one of the lowest risk investments you can have. Why? Because it's guaranteed by the federal government, backstopped by it's actually an insurance corporation that's run by the government. You've heard of FDIC? Yeah, right. So don't worry, your money's safe. Even though people say, your money's not safe. Yes, it is in a bank. Is it liquid or illiquid? No, it's very liquid. Very liquid. You want your money tomorrow, they'll give it to you. Tomorrow? Yeah. If you come in and ask for $77,000 in cash, they're going to look at you and say, well, look, we'll give you a check. But we don't have that much money in the bank. And they don't. In the ATM machine next door, there's $200,000 in cash. That shows you how safe they know the ATM machine is. But they will then say, you got to come back tomorrow if you want it in cash. And they will then call the FBI and say, we're reporting a suspicious transaction. Yeah. People say, well, it's over 5,000, over 10,000. Doesn't matter. There's no dollar amount. If it's a suspicious transaction, they have to call the FBI, and they're not allowed to tell you that they're calling the FBI. Part of the Patriot Act. How about Nestle Foods? We already made mention of them. Food company. It's the world's largest food company. Is it a security or property? It's a stock, so it's a security. Is it debt or equity? Well, if you buy the stock, you are buying part of the company that is, that is equity. So you're a part owner of Nestle Foods. Now, you're a tiny little part owner, but you are a part owner. Is it direct or indirect? Well, your name's on the brokerage account, so your name is on the stock, and you are the direct owner of that shares, or how many shares you have. Is it domestic or foreign? It's based in Switzerland. It's the world's largest food company. It's based in Switzerland, but again, it's a company which is a country unto itself. And believe it or not, folks, they make 30% of their money selling food not to humans. Who are they selling it to? Pets, animals. Yeah, right. So they're not dumb. Short-term, intermediate term, or long-term? Well, in general, we like to think of our stocks as long-term investments, but it's Nestle. So, intermediate term, maybe, because, stocks could drop 20% in 1 month, 1 week, 1 day. They've done it before. They're going to do it again. So we like to think of stocks as long-term investments. Low, moderate, or high risk? Typically, we think of stocks as fairly high risk, but it's Nestle, so moderate, yeah, okay. Liquid or illiquid? Oh, it's very liquid. Somebody's going to want to buy your shares of Nestle. Now, what about Southwestern College Proposition AA and R bonds? And I think there's another one called Z or something like that. What are these things? Well, you know what? You've seen that stadium. We didn't have a bake sale to build that stadium. We had to get a loan. And the loan is in the form of bonds, municipal bonds, because Southwestern is a municipal entity. It's a governmental entity. So is it a security or property? It is a security. You're buying the loan. And Southwestern promises to pay you back the principal and interest over 30 years. Debt or equity? It is debt. You are a loaner. You are lending your money. Is it direct or indirect? Well, again, depending on your brokerage firm where you bought the bonds, it's probably direct. It probably has your name on it, unless your lawyer has set something else up, in which case you may not have control over it anymore. Maybe some kind of irrevocable trust. And those of you who are would-be lawyers, you're going to learn all about trusts and all that stuff. For the vast majority of us, no. We just talk to the lawyer and let them decide. Domestic or foreign? Some people call us Tijuana Tech, but there is an Instituto Tecnológico de Tijuana. So no, we're still domestic. Short-term, intermediate term, or long-term? Well, some people hold their bonds for the long term. Bonds can also be intermediate term investments. And there is a way for bonds to be short-term, but we'll discuss that much later on. Bonds, intermediate to long-term. Low, moderate, or high risk? Southwestern College is in a district, Southwestern Community College District, that's fairly well off. And so that's how the bonds are paid, by the property taxes of the people who live in the Southwestern Community College District. So it's fairly low. Maybe you could say moderate, because during the financial crisis, there was a lot of angst and worry that the bonds would be paid, but they were all paid. So I would say low to moderate. It's not high risk. We're not high risk. Liquid or illiquid? No, very liquid. Somebody's going to want to buy your bonds if you wanted to sell them. How about a duplex in Spring Valley? You rent one and live in the other. Now, here's a very different type of investment, isn't it? It's not a security, it's property. You are owning real estate. Debt or equity. Well, you bought it, you own it, you're an equity owner. Direct or indirect. Again, unless your lawyer has set up something completely different, your name is going to be on the registration, your name is going to be on the title to the deed to the property. Is it domestic or foreign? Yes, Spring Valley is in the United States. Short term, intermediate term, or long term. In my humble opinion, real estate should always be considered a long term investment. You're going to see on the telly and on the infernal net all these people who want to flip in real estate, and I wish them a lot of success. It's not as easy as they make it out to be, folks. I think you should consider real estate a long term investment. Low, moderate, or high risk. Well, there are times when real estate can be very high risk, especially when prices have been bid up to outrageous amounts, kind of like now. But relatively moderate if you have the wherewithal to live through any dips. Obviously, if you're living in it, you get to live in it too, and you get to rent out the other one. So moderate. Liquid or illiquid. Remember, the poster child, right? The poster child for illiquid investments is real estate. So it's going to take you, well, nowadays maybe not that long, but at least a few months to sell your property. Qualcomm, and it's supposed to be all uppercase, and I don't like that, but so I write it lowercase, but it's supposed to be all uppercase. Qualcomm, what is it? Stadium? No, not anymore. Well, now it's called Snapdragon or whatever. Is it a security or property? It's one of the largest employers in San Diego County. It's a security. You're buying a stock of Qualcomm. Debt or equity, you are part owner. Tiny little owner, you buy one share. Direct or indirect, on the brokerage firm, your name's on the title, your name's on the registration. So it's direct. Domestic or foreign? Well, here's a real interesting situation. Qualcomm is based here in the United States in San Diego, but they make more money outside the United States than they do inside the United States. So figure that one out. But it is a domestic company. Short term, intermediate term, or long term? Well, my humble opinion, stocks should be considered long term. Okay. Low, moderate, or high risk? Well, in this case, tech, yeah, high risk, folks, even though it's done very, very well. They are competing against some of the biggest tech companies in the world, and they're actually holding their own. God bless them. And then liquid or illiquid? Fairly liquid. Yeah, somebody's going to want to buy your 100 shares of Qualcomm Corporation. And now our last example, a loan to Uncle Harry. Excuse me. Everybody's family has an Uncle Harry. Tio Lucas, yeah. It's a loan, right? So it is a security or property? Well, it's a security. It's a debt type of investment because he owes you that money back. Direct or indirect? Yeah, direct. Your name is on it. You're stuck with it. Domestic or foreign? Well, he's still based here until you get a postcard from someplace or overseas. Short term, intermediate term, long term, or maybe forever. Yeah, is Uncle Larry going to pay you back? Is it low, moderate, or high risk? It's super high. Speculative risk. And liquid or illiquid? Incredibly illiquid. Nobody's going to want to take over your loan from Uncle Harry. You're stuck with it. So hopefully now you've seen that investments come in all flavors, sizes, different attributes, different characteristics that we need to be able to assign to various types of investments. And again, as I said, relax. We're just now looking at it from very far away, and we're going to be coming in closer and closer and closer, and getting involved in the trees and then the leaves and in more and more detail as we go along. But for now, all you have to know is what is in this presentation, what is on the study guide. Forget about everything that your crazy uncle, he's a self-assigned expert on everything, including investments. Forget about what you saw on the infernal net and the television. Just concentrate on what we have here. And I hope we've piqued your interest. I hope we have you interested in learning about investments, because, folks, this class could change your life. There's a huge opportunity for people out there in the industry. There's a whole bunch of us ready to retire. The statistic is 50% of insurance agents over the next 10 years or so are going to retire. And so think about it. Did we mention the salaries are higher than the national averages? Again, we want to thank you so much for being in our class. We're so proud of you. We're so grateful and honored and happy that you're here. And in our next presentation, we're going to get a little closer now. We're going to take a look at the investment universe and the various alternatives. Just don't worry, you don't have to, all you have to know is what in these presentations. And then after that, we'll zero in on the eternal struggle of risk versus return. Thank you so much for being in our class. We're all so proud of you.